Who'd risk $2.5 million to make 5 times that? So $12.5 million. I backtest say $500,000 of drawdown for $2.5 million of profit. Now, if that's the case, I shouldn't have any problems attracting people, but I have a problem when it comes to understanding some of those statistics. For instance, if the drawdown is $500,000, why is the account size required only $133,000? You expect it to be much higher. If you increase the position size to the quadruple pyramiding strategy that I use, you increase the account size required to 2.6 million and you make less profit. So what good is that? I feel like if I had, the best servers, co-located, didn't have to worry about data feeds or anything like that, I would go off without a hitch. The problem is, when you play the game, the program is watching the continuous contract, and there seems to be some difference between the continuous contract and the real contract. It doesn't always seem to be the case that the forward contract or the front month contract is necessarily always the same. So you have things that happen whenever the front month is ending. You have to stop using your current front month and roll over to the next one. So you sell the current front month, you buy the next front month. I think that should be done by watching open interest falling by 10%. So if you have 100,000 open interest, if it drops to 90,000, that's a signal to roll over into the next contract. But I haven't back-tested that, but that's kind of what I use. I feel like in the few days where the front month is ending, the next contract tends to move almost the same. But I set the profit targets, well, not on the strategy, but I use a position size that produces $10,000 per month per contract. Well, not per contract, but the type of contract, not as in one contract makes that much, but one contract, one, like NQ or ES, that $10,000 per month per contract. And if that's what I'm basing it on, that drawdown, it's $500,000, but like I said, somehow the account size required is only 262,000, so there must be some effect on the exponential growth of the model. So if it falls 20%, that 20%, when it grows to 2.5 million, starting at $1 million, is a larger amount, or maybe smaller. Let's see, $1 million account, risking $500,000, makes 2.5 million, and that's not including fees, but it is including one tick of slippage and about the same amount for commission, which the commission on those is pretty good. So if I find 10 investors, maybe one puts $1 million, one puts 10 million in, the guy with the 10 million is risking $5 million to make 25 million. And if I risk 25 million, well, you make 5 times that, it's 125 mil. And I can't think of any reason why, if you had that much money, you don't just pyramid the thing. Like the pyramid works, you get 4 contracts. For the best strategy, I think, is to keep it, with up to 4 entries, but they have to be different entries from the program. They can't be the same. But if you wanted them to be the same, let's say you had a really large portfolio and you could use 20 separate entries, 50 separate entries, and 200 separate entries, 500 separate entries, and those 500 separate entry models have a profit factor around 10 on both the short and long side, because the price keeps falling. And it's not necessarily that it's averaging down, because it could average up. It does. It just depends on where the price is. If the price is falling, just because the price is falling doesn't mean it'll trigger a buy. There has to be preconditions which trigger the trade. So in those models with multiple contracts, I see a much greater profit factor on the trades. But the 4 different entries, the quad pyramid, and that one, the one I'm talking about, risk $500,000 to make 2.5 million. And I don't know if people think that's worth it. That's in 3.5 years. So go back to 2008 and you test these things, the account size required 262. when the maximum drawdown was 500. So go figure, why is the account size required on 500? And then the third parties I see online, they multiply the account size required, which is that 262, by 3. And when you multiply it by 3, you get a multiple that you divide the total net profit, which is 2.5 million, about by 262 times 3. At 262 times 3 is 750 to 2.5 million. And you compute that, it's about 3.19. And you subtract 1 from that and raise it to the 1 over 3.5. And when you do that, you see that the annual return is 135 or 130%. And what is the drawdown? Well, since I'm using the same amount of shares, it's hard to say, what the drawdown would be. If you've made a bunch of money before you made the trade, you'll get a value that doesn't make any sense, because there's only 1 year where the system made 150%, but in TradeStation, the only trades that count as profit are trades that have been closed. So you have closed trades that make money, and all the while you might be open a position for 2.5 years. If you let a futures contract roll, there's going to be a lot of extra costs in it, especially if you're using the same amount of contract. You're basing your assumptions on that fixed amount of contracts, and the target $10,000 per month. That's $120,000 per year per contract, and no matter what, you just use basic genetic optimizations, and these robots come out with profit targets that you can set. Like if you start out with 1 contract per entry and you figure out what the single contract is, then you can multiply by 4, get about the same amount, but you have to run different back tests for each of these. So there's a single entry, there's a quad entry of different entries, and then there's entries regardless of whether it's different or not. So you might scale up from the 4 quad pyramid to the dodeca pyramid, which is 20. Then you might go to the quinteca pyramid, which gives you 50 entries. Then you might go up to the docenti entry, which is 200. And all the while you have a quintcenti entry of 500, which has an extremely high profit factor and is the best model to use for institutional trading. Some of the problems I have with the models is that they react to price, and the market fell a bit from the highs this year, but it was holding long from positions taken before October 2008, so you can imagine how much the drawdown was on that. But the profit factors on any of these can be whatever you want them to be, really. But I guess it comes down to how much you want to risk, and most of them risk between 20 and 40% of equity. And if the drawdowns are unfortunate to happen all at once, which in the correlations that I look at, that doesn't seem to be the case, that they happen all at once or all together at the same time. But the $10,000 per month level could be $100,000 per month if you wanted it to be. Your account size was large enough. You could notionally fund that 262, but just bear in mind you might be called upon to bring up 500,000. I'm sure that's why, you know, the people use 3 times the required equity size. So whatever that is, you multiply by 3, take the total profit with closed profit and open P&L, divide it into the account size by 3, subtract 1, raise it to whatever the time period is, 1 to the 3 has 3.5. And some of these models, especially my Paris systems, they make about 235% annually, and in the current version the Paris system is up 72%, but I'm nowhere near that, which I guess, having made the changes in mid-July, we'll have several months before we see how those models actually did. And I'm sure if I make the calculations, I can target the drawdown, especially the way I did that when I was using percent of equity percentage sizing. I was able to take a max drawdown per contract of 5%, but these 5% drawdowns were minuscule sizes, like 1.7% of equity, and that's, if you have $1 million, 1.7% of $1 million is $17,000. So the $17,000 gets divided into the margin per contract, and I've not looked at it, but I think some of the margins per contract differ between brokerages. Some of them are different, and I've actually found some brokerages don't even have margin requirements, or essentially have no margin requirements. You might see a $500 margin for an S&P, and that's worth like $60,000. So I guess if you wanted, you could have an excessive amount of contracts, but I think I could fine-tune the margin required in order to compute the percentage of equity sizing. And if I do that, then I could probably adjust the drawdown. Like, I feel like the contracts are, at least when it comes to the 6B futures, 6A, 6J, 6E, 6, I think I said 6A, 6M, all of those, I can't seem to find a set value of margin. Like, the exchange has their requirement, but some brokers are different, and I guess depending on the broker, you're going to get different results. So if someone wanted to risk like 2.5 million, I guess I'm using a multiple of 5 to get that. So you risk 2.5 million, you make 12.5 million, but you risk 5 million in the process. That means you need about 7.5 million to do it, or at least to feel comfortable. Although anyone with that kind of money, I guess, be pretty disappointed if your first month is down $5 million. That's not good. But I guess if you're following a long-term trend, you can let it ride for a long time, and until the trend changes, you get out. But most people don't know when that happens. Well, my models do. It's not an idle boast. I mean, could show you every single back test I do, and optimization always comes out profitable, unless I give it too few degrees of freedom. And some people might ask, or might say, that 1 times 10 to the 15th in terms of probabilities is an enormous number, but we just crossed the petaflop threshold. So we got, I think I read, a Chinese computer that can do 2.57 petaflops of calculations per second, and that's incredible. But I don't have access to a computer that's capable of doing that, and it's kind of unfortunate because I'm just taking it for granted that once I get my hands on a computer that's capable of doing that, I'll be able to find the best results with the genetic algorithms I have in multi-charts. But if multi-charts doesn't work, the issue is more, what is more realistic, because even if I do that, I can't account for the effective roll, and I can't figure out what's going to happen if I reduce margin requirements. I end up with a disproportionate amount of contracts in one security. You'd think percentage of equity position sizing wouldn't have that problem, but if your margins are wrong, you will have that problem. You'll take too many contracts despite the percentage of equity being small. So 17,000 in that $1 million account in a single contract is 1.7%. So spending 17,000 divided by margin required per contract, and that's for the single entry. That's just one entry of one contract, maybe, or however many contracts, but it's not actually the best in terms of profitability. Adding or pyramiding, I found that a dual entry works best. So it's not averaging down, at least that's not the intent, but averaging up, averaging down. Anyone who sees you buy a position more than once, they're gonna give you shit about it and tell you that you're not supposed to do that, but I guess you can, especially if your model says you're